In our earlier session about the basics of trusts, I talked about how trusts work. A trust is a property management arrangement under which you entrust the management and disposal of your property to someone you trust. The profit the property yields is returned to you or someone you designate, such as family members. In a trust arrangement, one who entrusts the management and disposal of property to someone else for a purpose is called a settlor. One entrusted by a settlor to do so is called a trustee, and one who receives benefits from the property is called a beneficiary. In this session about the functions of trusts and their applications to trust products and services, you will be hearing the terms settlor, trustee, and beneficiary frequently. Please familiarize yourself with those terms. In post-war Japan, trust banks drove the growth of the trust business in the financial sector. As part of talking about applications of trust functions, I'll touch on trust products and services offered by trust banks. A trust arrangement under which a trust bank serves as a trustee is sometimes called a business or a commercial trust. In the previous session, we learned that a trust has property management, bankruptcy remoteness protection, and property conversion functions. In addition to those three, a trust has a property segregation function to isolate a portion of a settlor's property to create a standalone trust property. Any trust has all these functions to varying degrees. Trust banks incorporate one or two of these functions into developing trust products and services to meet specific needs and purposes. In this session, I'll talk about what trust products and services use which functions and how. Let me begin with a trust investment function, which is one of its property management functions, and its bankruptcy remoteness protection, which makes a trust distinct from other property management schemes. When you think about trusts, what comes to your mind first may be securities investment trusts or pension trusts. Those trusts are called investment type trusts for having an investment function and bankruptcy remoteness protection designed to preserve the integrity of trust property. How are these functions applied to a corporate pension trust? Bankruptcy remoteness protection was incorporated into corporate pension trusts before an investment function was, which is a variation of property management functions. In Japan, trusts are used to manage corporate pension plans adopted by joint stock corporations and other private sector businesses. Unlike government-sponsored pension plans, a corporate pension plan is an arrangement under which an employer pays into a pool of funds that will be used to provide pensions and lump sum retirement benefits to employees for their service when they retire. It's an arrangement under which an employer commits itself to paying pensions and retirement benefits to employees based on their years of service. Pension assets, which are the source of such payment, are pooled either internally or externally. When corporate pension plans were first adopted by Japanese businesses, pensions and lump sum retirement benefits were paid to employees out of internally reserved funds. In those early days, there were cases when employees did not receive any pensions or retirement benefits entitled to them when their companies went bankrupt, and corporate assets, including internally reserved pension funds, were withheld by creditors to pay off debts. Those cases prompted employers to externally pool their pension assets into trusts, which were protected in corporate failures. In an external reserve scheme, an employer enters into a pension trust agreement with a trust bank, under which the former serves as a settlor and the latter as a trustee. The employer pays its contributions into a third-party beneficial trust that pools pension funds and is managed by the bank, with employee recipients of pensions and lump sum retirement benefits designated as beneficiaries of the trust. The trust bank manages, invests, and disposes of the pension assets on behalf of the beneficiaries. In this third-party beneficial trust, the employer pools its pension assets externally. The pension assets constitute trust property legally owned by the trust bank, not by the employer, and are managed, invested, and disposed of solely by the bank. In a corporate pension trust, pension assets are separated from the employer's corporate assets. Therefore, financial institutions and suppliers that have loan claims and accounts receivable against the company may not seize the pension assets. Moreover, if an employer goes bankrupt, trust property may not be used as a source for repayment of its debts to creditors, and pension assets are protected for their recipients and subscribers. Trust banks that serve as trustees are not immune to bankruptcy. Should a trust bank fail, trust property under its management will receive special legal protection under the Trust Act. Trust property is legally owned by a trust bank, but is bound by the purpose of the trust. It's treated separately from the bank's own property and reserved for the designated beneficiaries. Therefore, trust property may not be used as a source for payment of debts to the bank's creditors. As a result, pension assets are protected from insolvency proceedings of the bank and remain intact for the recipients and subscribers. This advantage of trust property is referred to as a bankruptcy remoteness protection. It's sometimes called independence of trust property. This is because trust property, which is legally owned by a trustee, is treated separately from the trustee's own property. All these advantages enable corporate pension trusts to provide sophisticated asset protection for their recipients and subscribers. Externally reserved corporate pension plans were first adopted in Japan as qualified retirement pension trusts in April 1962 under an updated taxation system. Subsequently, employees' pension trusts were established, which incorporated a substitutional portion of the government-sponsored pension plans. And today, under a new pension act designed to provide even greater protection to recipients, defined benefit corporate pension trusts have become one of the standard forms of employer-sponsored pension plans. In the past, defined benefit plans were the dominant form of corporate pension plans. Under the plan, amounts of pensions and lump sum retirement benefits employees are to receive when they retire are predetermined based on their wage levels and years of service, and the employer commits itself to paying those amounts to employees. Under a defined benefit plan, the employer asks the trust bank to invest its pension assets in loans, stocks, and bonds on its behalf, so that the employer will be able to fulfill its commitment on pensions and retirement benefits to its employees. Moreover, the employer defines an investment policy for its pension assets and determines the amount of contributions to be made to its corporate pension plan using a mathematical model based on predicted investment income, wage levels, hiring plans, and employee turnover. Trust banks fulfill their responsibilities as trustees to protect corporate customers' pension assets. They also leverage their wide-ranging investment vehicles and financial management expertise to provide a variety of services at one stop. Services include investing pension assets, keeping track of the pension balance, managing their recipients and subscribers, and paying pensions and retirement benefits to them. A prolonged economic downturn, triggered by the bursting of the bubble economy in the 1990s and compounded by the collapse of the Lehman Brothers in 2008, combined with ultra-low interest rates, made it difficult for many businesses to achieve anticipated investment income from their pension assets. As a result, their pools of pension funds began to fall short of what they should have been. Employers now needed to increase their contributions to the pools to make up for the shortfall, which would place a heavy financial burden on them. In addition, the labor market was becoming increasingly mobile, with traditional lifetime employment no longer the established norm. It was against this backdrop that a defined contribution corporate pension scheme was introduced in October 2001, modeled after 401k plans used widely in the United States. A defined benefit plan is an arrangement under which the total amount of future benefits to be paid to employees is first determined, based on which the amount of an employer's contributions to fund the benefit payment is calculated. In contrast, a defined contribution plan is an arrangement under which the amount of contributions is first determined, and the sum of contributions and their investment income determines the amount of future benefits to be paid to employees. In a defined contribution pension plan, the employer pays into a third-party beneficial trust with employee recipients and subscribers designated as its beneficiaries. Each employee has their own account in the trust and is responsible for choosing and changing at their own risk financial products from among deposits, securities investment trusts, and insurance products in which to invest their share of the funds. The trust bank enters into a defined contribution pension trust agreement with the employer, under which the employer serves as settlor and employee recipients and subscribers are designated as beneficiaries. Under this agreement, the trust bank manages and protects the pension assets represented by contributions from the employer. The bank signs an additional contract with the employer to provide administrative services for the pension plan. In a defined contribution plan, the trustee provides services to manage and protect pension assets by leveraging mainly the trust property management function and bankruptcy remoteness protection. The Trust Companies Association of Japan announced that corporate pension assets totaled 82.5 trillion yen under defined benefit plans and 16.3 trillion yen under defined contribution plans as of March 31st, 2021. Let's move on to a trust financial intermediation function, which is part of its property management function. Financial intermediation is about channeling funds between lenders and borrowers. It's one of the most important roles the banks play in stimulating the economy by circulating funds as the blood of the economy. Banks fulfill this role by collecting money from depositors and lending it to businesses. Loan trusts and money trusts are financial products that use a trust financial intermediation function. That's why these products are called savings types trusts. First, I'll take a loan trust as an example to talk about a trust's financial intermediation function. Loan trusts are financial products established by the Loan Trust Act. Under identical terms and conditions of a loan trust, a trust bank enters into trust agreements with a variety of settlors that contain identical trust clauses. Money received from settlors in each subscription period forms a unified investment fund and is invested primarily in loans and bill discounting. There are 13 such investment funds, 12 investment funds, and an additional fund for profit management. A loan trust is a variation of money trusts, in that it jointly invests money received from subscribers, settlors, in investment destinations and vehicles specified by its trust clauses and return its investment income in cash based on investment performance to settlors. The difference between a loan trust and a money trust is that the former invests essentially only in loans and bill discounting and is a self-beneficial trust that designates settlors as beneficiaries. Just like time deposits offered by banks, loan trusts are redeemable after 1 year and provide principal guarantee to their beneficiaries. In the early days, funds raised through loan trusts had been lent exclusively to companies in key industries such as power, steel, and coal, before the scope of borrowers expanded to include those in the manufacturing sector, such as chemicals, automobiles, and electrical equipment. To meet the considerable capital needs of businesses during Japan's high growth period in the 1960s, loans were provided mainly at a long-term floating prime rate, updated every 6 months. Initially, fund management at a long-term floating prime rate was so successful that trust banks were able to indicate to their customers, at the time of offering, higher expected returns on their loan trust products than the prevailing bank deposit rates. Loan trusts gained popularity among investors for their high yield, principal guarantee, and redeemability after 1 year. They became main products offered by trust banks, with their balance having peaked at 56 trillion yen in March 1992. However, the low interest rate policy implemented by the Bank of Japan in the 1990s dampened the corporate demand for long-term borrowing at a long-term floating prime rate. This made it difficult for trust banks to keep investment returns high on their loan trust products, which in turn made loan trusts less attractive savings products to potential investors. Loan trusts faced further headwind. First, it was a challenge to manage 13 investment funds effectively. Secondly, securities investment trusts and other management products gained popularity, driven by the savings to securities trend. And thirdly, large denomination time deposits offered on a liberalized interest rate regime emerged in the wake of the deregulation of interest rates. All these developments combined to make loan trusts less and less enticing. Their balance had followed a downward trend since 1994, and trust banks have increasingly stopped handling loan trusts since 2000. Loan trusts are designed to divert collected funds directly to long-term loans offered at a long-term floating prime rate. When corporate demand for such loans dwindled, loan trusts lost their appeal as lucrative financial products. In contrast, money trusts, a variation of savings-type trusts just like loan trusts, take advantage of their greater flexibility and come in a wider variety of products. A money settler, a money trust general, is officially called a joint management designated money trust. It's an arrangement under which a trust bank enters into trust agreements with a variety of settlers that contain identical trust clauses. Money received from settlers is jointly invested by a unified investment fund. Subscriptions to money trusts are accepted daily, and subscribers can add money to their trusts at any time. Just the same as loan trusts, money trusts offer principal guarantee to subscribers. A money trust, whose duration is a minimum of 1 year, is an arrangement to invest money received from settlers in investment destinations and vehicles specified by trust clauses and return investment income in cash based on investment performance to its beneficiaries. Unlike loan trusts, however, money trust investment destinations are not limited to loans or bill discounting, but also include public and corporate bonds, stocks, call loans, commercial papers, real estate, trust beneficiary rights, and deposits. Investment vehicles for money trusts also offer variety. This includes securities lending, securities future trading, securities options trading, and financial futures trading. As funds can be added to money trusts at any time, they are used also for workers' asset formation savings plans as asset formation trusts. Unlike with loan trusts, special provisions can be added to money trusts. That's why a variety of special purpose money trusts have been created. For instance, an educational fund trust is an arrangement to save money for children's education. A charitable trust is an arrangement to donate investment income to charitable social causes. An adult guardianship trust is an arrangement to support an adult ward. Moreover, money trusts allow settlers to designate their family members or other third parties as beneficiaries. Therefore, they are used also for educational funding gifts trusts and marriage and child care support trusts, both of which offer tax benefits when settlers give monetary gifts to their children and grandchildren. As you can see, money trusts have greater flexibility than loan trusts. This makes it easier for trust banks to offer a wider variety of money trust products to meet diverse investor needs. This concludes my presentation.